Well, good afternoon, everyone. This is Rob Gallo from PassiveInvesting.com. You're joining us today in our next masterclass, our June 27th edition. Whitney, fortunately enough, is taking some well-deserved PTO, so we all wish her to have a good time today for this week and her time off. Today, I'm joined by Gary Pinkerton and Jaden Zuel. And what we want to discuss today is really how to use a cash flow life insurance policy to invest in syndications, really amplify the returns. And so that's what Gary is here today to talk about. Gary, it is a pleasure to have you today, and welcome Jaden as well.
Thank you very much. So Rob, I'm
Gary,
going
to tell us about yourself. Tell us about yourself.
I was going to cover a little bit of that while we went through this. I'd like to introduce Jaden, if you don't mind. So Jaden and I are business partners. We've been together at Paradigm Life. So I first got there in 2011 and Jaden shortly after. And we work together, we travel together, and have very similar experiences. And so Jaden, I'm going to have you just intro a little bit, and then you'll hear from Jaden from time to time as we talk about, some of the other questions that have come up along the way.
Absolutely. Yeah. So I appreciate it, guys. I may have met some of the people on this webinar today last week or 2 weeks ago now, I guess, in Charlotte. So hopefully I've had a chance to get to know a couple of you, and we'll get a chance to know you even better. But like Gary said, I've worked with him since I think it was 2014 now. So we've worked together a long time. We work on opposite ends of the country. So he's out in Florida, I'm up in northern Utah, but we work with people in every state. So we're excited to get to know a few of you and hopefully help you understand cash flow life insurance a little bit.
Awesome. Thanks, buddy. So Jaden will be watching the chat, as will Rob. And so Rob will kind of, I think, lead the conversation. But I'm just going to start off real quick, Rob, with my sharing the screen, and I'll adjust this thing as necessary to kind of go with the format and the flow. So hopefully I'm sharing a screen that says Supercharged Real Estate Investment. And so there's a lot of terms for this, high cash flow whole life insurance or infinite banking, family bank. But it all comes down to more strategically using your money and your wealth. So who am I? So I came across this approach in 2011. I run a podcast on the left-hand side of your screen called Gary's Gulch. It's all about how to help individuals build agency in their own lives. And that's not a word that we use a lot right now or in the recent times. It was very heavily used 100 years ago. It just simply means that if you have agency, you have the capability, financial and otherwise, to make your own life decisions, like lead the path that you want to lead, and do the things that you want to do in your life, teach your family what you want to teach them, live where you want to live. And it is my belief, and studying American history and studying world history, that if the general population has agency like we did 250 years ago when we started this country, where if you grabbed a piece of land, it was yours, then we had freedom, right? And as we give that up, as we become beholden to somebody else for our paycheck, for making sure we're safe, for making sure that our food shows up, then we give up more and more and more of that ability to have independence, freedom, and agency. So that's really what my big focus is. And it goes right to the point of helping you put in place a personal banking system and then make investments that you control and that you can control the outcome of, which means that you make money and don't lose money on them. So I love helping people with syndication, with multifamily, with buying their own real estate. So does Jaden. And so that's really what drives me, and that's my passion. We have a ton of courses as well that you can dig into at Paradigm Life that will help talk about these concepts. Some of them are myself and Patrick Donahoe, our CEO. Some of them are Jaden and me, Jaden himself. So there's a lot of resources, a lot of opportunity out there. We're both big-time real estate investors. Love it. It's the cornerstone of our finances, excuse me. So I'm 54, though, a little bit older than my business partner there. And I'm even older than Patrick Donahoe, our CEO. I grew up in Southern Illinois on a dairy farm in the late 70s, early 80s. And so I was a teenager in early 80s. And Jimmy Carter had just been president. Ronald Reagan comes in. Paul Volcker is the Fed chair. And we have high inflation, and we have gas lines, and we have stagflation, which is people's expenses going up faster than their incomes. And so that probably sounds a little bit familiar. I mean, the gas lines aren't there, but the rest of it's there, right? And so it's kind of repeating itself, or at least it's rhyming with what I grew up with as a kid. And those high interest rates that Reagan and Volcker put in place to stop inflation went to 21%. And we had variable interest rate loans on my farm. Now, that sounds really stupid to have variable interest rate loans, but it was, I like to remind people that it was the 70s and 80s that actually taught us in America the pain that can come from high interest rates. We had not seen it before that. But I mean, maybe back in the 1800s, but no one that I knew had ever seen it. And so whatever reason, we had variable interest rate loans. We lost our farm, got foreclosed on, and we were living in a trailer on my uncle's land. And I couldn't wait to get out of Illinois. And so I embarked on a free education at the Naval Academy, which I was really grateful for because it was free and because it was a long ways from Illinois. And I also wanted to get a W-2 job, a safe, secure job. Like you hear that jingle all the time. That's the jingle I was listening to for 20 plus years. I also got super inspired about patriotism and service in the military. And I loved commanding this warship right here, the USS Tucson, which is a nuclear powered attack submarine in Pearl Harbor, Hawaii. I finished that up though in 2011, was my 4th submarine. And then after that, I went off to work for the Joint Chiefs at the Pentagon. But this was a really unique time. It was a great experience on the submarine, but I was in the Pacific Ocean paying no attention to my finances for nearly 2 years, a really important 2 years. And when I finally gave up the submarine to the next guy and paid attention, I'd lost half my family's wealth in the markets because I was just doing what everybody else I thought was doing, which was dollar cost averaging, in it for the long haul, mutual, a balanced portfolio of stocks, bonds, and mutual funds, all the little jingles that I've now mainly forgotten. But I knew I had this pull to get hold of real estate, and I really couldn't explain why. But as I went through this journey, I started to figure it out. So I went to a bunch of Robert Kiyosaki events. I read every book I could find. And eventually I came across this guy named Patrick Donahoe, who had this small company that was only a few years old and called Paradigm Life in Utah. Just celebrated, 15 years, I think it was, as a company, 20 years maybe. But great company now, lots of people working with us. And Jane and I were really kind of the early wealth strategists that started working with Patrick. He wrote this book in like 2018 that has a really impactful analogy that he stole from Abraham Maslow, or we got from Abraham Maslow. And Maslow was saying that, hey, this Egyptian pyramid is a man-made structure and an example of something that has stood the test of time for thousands of years, somewhat because of its shape, but primarily because they didn't skip any bricks. I mean, you can imagine what would happen if they just left half the bricks out because they were lazy and they wanted to get to the top, right? It would fall down. And so he said, that's a good analogy for how you gain your place in life, what you were intended to be on this planet to do. But you have to first get through the foundational layers like food, shelter, and clothing, basic needs. And then he talked about community involvement and stuff. So that's not our goal, to talk to people about emotional intelligence. It's more about to relay what we've learned after tens of thousands of hours at this point with thousands of clients. This lesson that everyone kept learning that we were talking to, and that was certainly true for me. And that is that if you have a lot of control over your money, like who's got the money, what are they doing with your money, when are they going to give you back your money, and is it going to have a return on it? If you know those things and you can control the result of those things, then you have a pretty good likelihood that you're in very low risk, right? And as you give up control of that stuff, you send money off to some guy who said he was going to send you the Brooklyn Bridge, right? Or you put it in some stock because your buddy said it was a cool idea and it was going to make you a lot of money. That's where you're giving up control, you're giving up insight, and you're taking on more risk. And so as I start to paint out the top layers of this thing, the top 3 tiers, which are investments, I think it's going to resonate with everybody who's on this podcast or who are listening to this webinar in the future, because this is what you're looking for, right? I know it's what you're looking for because it's what I was looking for. And I started listening to the same things you're listening to. And that is my own directly owned real estate, right? My own businesses, investing in myself. Those are directly owned things, which are directly controlled things, which means that your risk is pretty low, right? Like a silly example, somebody may decide to paint your rental property pink and put it in a bad neighborhood and rent it out to total thugs, right? Like that's totally possible, but it's you, right? And so you can control that. And
Gary, I do like pink. I do like.
All right, that's awesome.
Just FYI.
Go for it.
Not the
My last name's
not the
Pinkerton. I used to get made fun of for pink, so I don't wear it.
Got it.
So anyway, you're in control of these things, right? You're in control of your own business. Then there's a more of an indirect investing level. So this is syndication, right? This is what my awesome friend Danny Randazzo and passiveinvesting.com and all the stuff that you saw in Charlotte, like that's what they're trying to teach you, that you can do this safely. It just takes knowing a little bit more about the jockey who's riding your horse, right? So if your money is your horse, you used to ride the horse when you were renting out your own property, but then you got those tenants and toilets calls, right? But Danny and Dan Handford will gladly take that over, and they're experienced to do it, and they're ethical individuals. And so when you find somebody who's at that level, you can do that still safely because you pick the right jockey to ride the horse, right? It's just that there's another layer here, right? So there's a little more risk if you don't do it correctly. And then above that is speculation. So I beat the markets up all day long. I do it unapologetically because it took away half my money. And the only lessons I learned is that this is quite a wild ride. Like I didn't learn how to prevent that from happening in the future. And I'm just not going to go and research every company that's in every mutual fund and go to all their board meetings that would be necessary to have the level of control to ensure security or certainty, right? So that's the investing world, right? And we help people every day strategically play this out, put the right bricks in the right layer at the right time for your situation. Underlying all this, though, is the whole reason you're having this webinar with us, which is what about the foundational layer? Like what sits underneath all this to make sure that that stuff can actually happen? I have tons of friends who were in the real estate world just killing it as rehabbers, as new construction guys in 2008, and then they were bankrupt in 2009. And they will still tell you, most of them today, I'm still working on them, but they'll tell you today that it was because they were over leveraged. And I always remind them, you aren't over leveraged. You were under liquid, like you did not have enough liquidity. And they're like, yeah, that's what I meant. And that's not really the same thing though. Like having leverage is not a problem. If you pulled $1 million of equity out of an apartment building and put it in a bank, and you'd have no problems, but they didn't do that. They put the money in the bank and then immediately used it to put in other properties and had nothing in the bank. That's where they got into trouble, right? So leverage is not bad, but having money sitting around so you can dig your way out of bad situations, and I seem to get myself into them quite frequently, because I'm out there leaning forward, trying to learn things up here before my clients have to learn them. So I often need a lot of cash, and I have a lot of cash sitting around. The question is where you're going to set it, right? And so in 2011, when I was buying this first property, I learned that I can first put the money down here, access it in the form of a loan so that my money sits here and continues to grow. And I'll get into a little bit more into that. Maybe this picture might help. So we call it a wealth maximization, right? It's infinite banking. And it is a uniquely designed whole life insurance policy whose job it is to, make sure that your money is safe, liquid, and guaranteed to always be there, and then grow better than the other options, right? And have other important features. It's private, it has life insurance associated with it, but it's a place where your money is going to grow in this tax-free internal environment at 4 to 5%. And you can access the entire value of whatever is here in this cash, and you can use it for any purpose on your terms. So there's no application requirement, and there's no repayment structure. So you decide when and how you're going to borrow and for what, and then how you're going to pay it back or don't pay it back, right? It's completely up to you to design that structure. So why is it so flexible? You have to understand that it's not your own money. The insurance company is holding your money in your policy and compounding and growing it, just like before you raised your hand and said you wanted a loan. The moment before that, it was just growing in this incredible environment. When you raise your hand and say you want a loan, it's still doing that. They've just given it a new job. It's now collateral for the money you borrowed from them or from a bank. But let's stick with the insurance company. So you borrow the money from the insurance company up to whatever you have available to pledge as collateral, and then pay them back on your terms. They've got your money. They're 100% protected in cash. They don't care when and how you pay it back. So hopefully that makes sense. But the other part of it is that this continues to compound and grow the entire time. So some people will talk about it as like doing two things with your money or earning 2 times on each dollar that you have. Specifically, it's earning inside this policy. And then if you decide, well, I'm going to go put some money to work and earn 10% on it, then you can borrow it at 5, for example, make 10% on it. And so it's earning again, even though it's still sitting in here. You've leveraged it and been able to earn it and grow it again a second time, right? So that's how we help individuals save and grow their emergency fund, reserves for their properties, and then a bunch of opportunity money. And you just borrow against it, make an investment that cash flows, do it again, make an investment in an apartment building or as a private lender or in the oil and gas industry, or fund somebody else's business, and you get cash flow back from that. And you just continue to cycle things through this hierarchy, building it ever larger and bigger, because as you have a larger foundation, a larger bank here, then you can support a lot more investments on top of it. So I'll
Gary,
pause there.
Can I ask you a question?
Yeah.
So so I'm sure a lot of our investors that are listening probably have some kind of life insurance policy.
Yeah.
Are we talking about taking a loan against that policy, or is this a different type of life insurance that's a cash flow life insurance?
Yeah, so you can borrow against your current policy. It likely doesn't have a ton of cash in it, right? I mean, most of us aren't thinking with a normal whole life policy to stuff as much cash as possible into it. So this is different. It's really just modified, right? So it's in the end, it's a cash management system. It's a foundation of your family's and your business's wealth. It's not really what I would call an investment itself, yet it's growing substantially better than other banking systems. And it's a place where you're going to specifically design it so that you can stuff a lot of extra cash in it. You have this optional contribution amount. Perhaps maybe you want to buy one rental property a year with your family savings that you're aggressively saving $50,000 a year, right? And so you put 50 into the policy, and then you can borrow, in the first year, like 40 of that. Eventually, to a few years down the road, you can borrow more than you're putting in, right? Because it's growing inside there. So put 50 in the first year, and then the second year, your commitment is really like anywhere from 10 to 50. You could do the 10 if you wanted to, right? And in a pinch, you might even be able to avoid that part. So it's quite flexible. It's not like do whatever you want on the contributions. You do need to kind of commit to contributing for 5 to 7 years, I tell people. And that keeps the IRS happy with the rules associated with being able to continue calling this life insurance over your lifetime and not an investment, right? We want to prevent the IRS from looking at it and going, nope, that meets the criteria of an investment, not life insurance. And so that has to do with how many years you contribute to it and how much you contribute each year. It's flexible. We can set it up to be really, really big, but it really kind of depends on each person. I hope that helped. It is uniquely designed.
So when setting these up, what specifically, because I think you had a good point there about we don't want this to fully be, I think, as an investment, but what does that structure look like in order to kind of meet all the criteria that you're talking about when we're talking about this whole life insurance?
Yeah, let me see if I can quickly go through to the page that I want to do without having to escape out and get to it. I think we're right here. Here we go. Okay, so let me go back to that one first. So I think I talked about these, but let's just quickly go through them, and then I'll show you that picture that I think will answer that question. So you need it to be so that you can contribute as much cash as possible for as minimal amount of death benefit as possible. That's what makes it grow most efficiently in the early years and be accessible. So minimizing expenses and charges, that just means keeping the insurance portion of it low. When I talk, by the way, about 4.5% to 5% for most people that we're putting policies on today, that is net of all this expense and charge stuff, right? So that's a net kind of internal return, and there's no taxes being charged. So you truly can compare it to after tax at a checking account, right? On the kind of the return. Have unlimited access to spend the money for whatever you want. That's, all these mutual whole life companies we work with, you will have that ability. And then allow for uninterrupted compounding, which just means you can borrow against it like we talked about in that picture. So what we're really doing is we're taking what people may or may not be familiar with, which is a 200-year-old product called ordinary whole life insurance. And it's a product where you make contributions for several years in a row, same exact contribution, very limited access in the first couple of years. It's been a wonderful product. It sounds kind of limiting, right? But it's a wonderful product when what you're focusing on is the life insurance, not so much the cash value. Like, it is growing the cash. It's just a little limited access at the beginning and not flexible on contributions. And so we modify it to be the thing on the right-hand side. We add a second feature to it, 2 more features really, but this second one here is the money one. It allows you to position most of the capital into something called PUAs, or paid up additions, or the overfunding cash part. And this portion is liquid when you put it in, and it's more flexible on, meaning that now you can contribute anywhere from this maximum 50K in that example I said, down to a minimum of like 10. So much more flexibility than just having to do 50 every year like that. So it's adding a couple of riders or features to it, Rob, that makes it act more like a bank in the early years.
So, and I don't want to be jeopardizing the presentation, but what are kind of so obviously, I think a lot of people understand the ordinary whole life, that death benefit being kind of the primary piece, the cash value accumulation, not necessarily the primary piece, but obviously it's there. What are the pros and cons then between what the maximize a whole life will do? Because obviously we all get sold on, well, in case of death, don't you want your family to be, okay? And I think, I mean, a great product, but it's kind of, you're rewiring our brains. So what are those kind of pros and cons?
Yeah, so it is interesting that normally when you go shopping for life insurance, if you're a guy, first of all, you're going begrudgingly because we, for some reason, don't think we're ever going to die. And but it's our wife who's bugging us, or our spouse, or somebody who's bugging us, right? So, but I think we're wired that way to make sure that the species doesn't go extinct. We all have our roles, right? And so I didn't want the
one track mind.
Yeah, right. I didn't want the life insurance. I wanted to do this without the taxes and without the life insurance. My wife pointed out a couple of years later that if you keep buying real estate, you better have a lot of life insurance on you, because I don't want to deal with this when you die, right? And so all of a sudden it was important for me. And because it got me what I wanted, so normally when you're shopping for life insurance, you're trying to get the lowest premium for the amount of life insurance, right? So if your wife says, or you in your own mind, you decided, or your banker says to start this business, you need $1 million of death benefit, then I'm out trying to figure out the cheapest way to get $1 million worth of death benefit, right? But if you get to this point where you're like, hey, I want to save as much cash in this tax-free internal growth environment that's much better, much faster growth than my checking account. Now I want to put as much cash as I possibly can in. And by the way, can we back off of that life insurance? So now all of a sudden we're trying to put as much cash in with as little life insurance as possible. So it's totally upside down, which is, like you said, you have to rewire your brain or stand on your head or something, to understand it. One of the third feature we added this, because there probably are a lot of people who are like, yeah, I like it, I think it's cool. I don't necessarily want to get rid of all the death benefit, especially if this is net of the life insurance. Like, life insurance is a nice added value if I don't have to pay out of pocket for it, right?
Right.
So the other thing I was going to say is that there's a third added feature where instead of putting, it allows us to really optimize. So instead of only putting 2/3 of the money up here, we're typically putting 80 or 85% of the money up here. And the way we do this is we actually add some blended term insurance to it. Again, no out-of-pocket contribution for that, but it actually brings back the death benefit, right? So I would get this death benefit really low on this original picture here, but when you add the other thing, it doubles or triples it, and it gets it back into something that's a decent amount. Again, it's still being funded in the background. So it's a nice combination of both in the end. I was going to show how I do it for an investment. Would that be okay?
Yeah, that'd be great.
So, and then Jayden, I'll pause if is there anything that I left out of there that you want to amplify or add?
Nothing just yet, but
Okay,
after you give your example, there might be a couple of things to add here.
Okay, cool. Yeah, sometimes I forget I have a complete expert there with in the bullpen. Okay, so this is how I buy single family homes, but you could replace this single family home with my next investment with passiveinvesting.com, my next apartment building, my next self-storage facility, next car wash, which is cool that they're kind of getting into that nowadays. All right. So whatever your capital outlay is, there will be a portion of it that you'll either use cash for, or you'll go and use, borrow against your bank for. So if it's not a single family home and all you're doing is putting 200,000 in, you're probably not getting a bank loan, right? But for single family homes, I think manna from heaven is the 30-year fixed rate mortgage. I have an incredible friend, Aaron Chapman, who I think's been on this podcast before, and he's my mortgage lender and has done 20, 30 plus loans for me over the last decade. And the reason I like this stuff, if you remember back to my story, we went bankrupt with variable interest rate loans. And I've realized since then that if the Federal Reserve is going to cause inflation, intentionally cause inflation, then I want to be in hard assets that go up in value, right? It's like owning gold. But if I can get somebody to give me a loan that's below inflation numbers, that's getting paid to own real estate, right? And so I want to get as much of this stuff as I can and have as many of these on there as I can, as long as they're fixed rate, right? And they're below the rate of inflation. So I love this stuff, but eventually I have to put a down payment in. And I'd rather not put my own cash in as a down payment for a few reasons. One, this renter may accidentally fall down, grab his neck and say, your sidewalk hurt me and I want to steal your property, right? Well, if there's no equity in there because I had somebody else put all the money in, that helps, right? It dissuades frivolous lawsuits. Certainly I'm going to pay somebody if I actually did hurt them. So that's one thing, is frivolous lawsuit. But the other thing is that your money is just not as efficient as I showed with my first rental property in that example. It's just not as efficient if I'm putting cash into the thing. So I want to put my cash up here, have it grow in this internal tax-free environment the first time, and then borrow money from the insurance company, have them put their money in here, use the cash flow to pay this back and grow and give me additional money. And so now it's grown a second time, right? I've used the money in this asset that is also growing. So I would obviously not skip payments here. That's really rough on my credit. But I will skip payments this way if I have, a make ready that I have to do, or I have a vacancy I didn't anticipate, the air conditioner goes out, I can just stop paying these guys. Again, it's unstructured. They don't care when I pay it back because they have my money sitting up here as cash, right? As a down payment. So I have a numbers example on that, but Jaden, anything to add, because you do this every day as well?
Yeah, I think the only thing I would add here is just the clarity that you could take that house and replace it with a business or replace it with a syndication that you're going in, right? This fits for any model. It's just the concept here of, okay, taking the money from the insurance company, not from your bank account, right?
Yep. Exactly.
Are there other gotchas that we should make sure people understand? And maybe if it's, like you said, this is just a single family home example, also syndication, what about for business owners?
Well, the real gotcha for business owners, I've had quite a few now in the last 10 years, is underestimating how much liquidity you need. And this will provide the liquidity slightly limited in year one. So you just have to understand that, or in the first 2 to 3 years. So in the first year, you're only going to have access to about 80% of what you contributed. It's all in there and growing at that 4.5% to 5% rate, but there's a 20% generally that's limited access for that first year. And then by year 2, it's more like, 15% limited, but it's still a decent amount of money. And it's getting better and better and better. And by year 5, you can look at it. And if you've operated it really efficiently, like tried to fill it up every year, then you could look at it and go, wow, look at that. I don't know, let's change the numbers. I've been using 50. Let's go big. Let's say 100,000 a year. Just understand it could be 10,000 a year, right? But 100K is really easy math. And so let's say you do 100K a year. And then in year 5, you're like, I put in 500. Look at that. I got 500 available, right? So now you're finally, and then in year 6, you've got more than you've contributed. And year 20, you've got twice as much you contributed. So it continues to snowball. It's just those first few years. I wouldn't call that a gotcha because it's right there available and you understand it when you start. But I just kind of like to highlight it that it's not as simple as putting money into a checking account. There is an annual minimum that we need to make sure is small enough that you could never imagine having challenges putting that in. So there's an annual minimum, and then there's a little bit of limited access in year 1. So you should have a longer term perspective. Like I did, no kidding, had a client who did this. And so this is my example now. I had a husband and wife. They had no kids. They were property managers in the DC area, and they were going to do it for 3 more years. And then they were going to shut everything down, cash in everything, buy a sailboat, and travel around the world for 10 years, and then come back. They were really young and start over, rebuilding money again. In that scenario, they did not want to be behind in year 3 or 4, or even just break even in year 5. They were essentially planning to be bankrupt in 5 years, and this wasn't a good fit. I haven't heard from them. I hope they had a good time and made it. But that's just that, so people are like, well, what if I die in the early years? Well, that is definitely not a business plan you want to play out. But as far as having this in your life, I mean, it's orders of, it's thousands of % return on your family's money. It was not a mistake. The only real mistake is, if you live along a really old age, the policy's still around, it's still growing like crazy. That wasn't a mistake. The mistake is like you go bankrupt in the first 3 or 4 years. And it's not a big mistake. The big mistake is that you're bankrupt. The fact that you had this thing around, maybe you were down 5%, that's like a bad week in the market or a bad day. Right?
That makes sense.
So, I mean, could the insurance companies go bankrupt? I mean, sure, anything could happen. these companies have never even had 1 year in 150 years that they haven't been profitable. So I'm talking about Mass Mutual, New York Life, Penn Mutual, right? Northwestern Mutual, The Guardian. Like, these are massive billion-dollar companies that carry $1 billion of cash sitting around. So they've never even had a year where they weren't profitable. You would think COVID-19, 2020 would have an impact on life insurance companies. It wasn't even a rounding error for these guys. So, I mean, in general, they're insuring pretty healthy people who have good finances and save a lot. And that's really good on both sides. It's a win-win situation when people do that.
Gary, in terms of the actual insurance companies.
Yeah.
Because I mean, when I spoke to my insurance agent, nothing like this came up.
Yeah.
Is it just this hidden secret, or is it, oh, we don't really like people to do this, or what is that about?
No, so they do appreciate attracting individuals who believe in both the life insurance and long-term legacy and long-term savings, not just people who are trying to put a neat trick in place to buy their real estate.
Yeah.
Right. So you will hear some companies like Mass Mutual recently, it kind of got blown out of proportion. But what many people took away from it was Mass Mutual is not interested in people putting in place high cash value policies and borrowing against them. They don't want that even happening, right? It's not what they said. It's the way it hit the headlines, of course, right? And so I will say that if you do come across that, they're just trying to have people who are reasonable and not trying to just squeeze everything they can out of, a vehicle, right? But every company we work with will do this. They will add these features. It's important that they will put something like a paid up edition rider on, for example, and you got to be able to blend some term insurance if you really want it to work well. So you do need to have those features to add, but we work with 10 companies. They will all allow that in some manner or another. They're all really good companies for that purpose. And so it's not a secret. It's just something that most agents and most insurance companies aren't that interested in doing. They don't make anywhere near, it's not anywhere near as profitable to be putting the money in this section up here as it is down here. And that's for both the agent who is your representative and for the insurance company themselves. So for a company to be willing to, allow you to put a majority of the capital here, they have to be a very large company with a long-term outlook who's looking for lifetime clients, right? Not somebody who's trying to impress the shareholders next year. So MetLife would never do this, is what I'm trying to say. Prudential would never do this.
Right.
Yeah.
Makes sense.
Mm-hmm. But in a mutual insurance company like Mass Mutual or Penn Mutual, we're the owners. And so the policyholders, they want to make the policyholders happy. So they figure out a way to make it financially beneficial and a good business model to do it. And they've, had success here with these features on the policies for decades already.
Yeah, that's amazing.
Yeah.
So Gary, the other question I had, just in terms of, for example, I just use my own cash to invest in a car wash. I don't know if you've heard.
Mm-hmm.
If I were to, let's say, take that $100,000, I don't know, is there any kind of math that you've done that says, all right, if you were to take $100,000 out of your own dollars, out of your savings account, versus if I use a tool like this, how much more would I be actually gaining from that type of investment approach?
So I love these softballs. It looks better that softballs in that could be a really hard one to answer, except that I happen to have a 50K version here. Oh, not there, here. If you would allow me to do a 50, I'll just double it. Actually, I could probably do that math, but I was just kind of kidding that it was a softball because it was double of this number that happened to be in this slide deck already. But this is actually an example very similar to what my first investment was. So I was getting a property on 14110 Volpe Drive in San Antonio. It's a big new fourplex in 2011. And I needed $50,000 additional. And I had my policies open, and I had room to put $50,000 in the policy and borrow against it. Or I could just use it from the checking account, right? So either way worked. And so I sought guidance from real estate investors, and most of them, frankly, didn't think of it in this perspective. They didn't think about the opportunity cost or the power of compounding of just using your cash all the time. So when I showed them, I remember going through this kind of math, and $50,000 borrowed at 6%. It's a little higher than what we really would borrow at today. Generally, you're earning 5 and you're paying about 5 on a borrowing rate. But, so I just wanted to keep them the same so that it was easier math. But this is about what I was looking at in 2011. And so if I borrowed the 50K, paid $322 a month to pay them back off, again, that's just my goal. You don't have to do that. So 25 years, I would have it paid off, and paying at 6% during that period of time would be $47,000 in a normal bank loan, that I set up for myself. As soon as I showed them the 47K and the 50, they're like, well, that doesn't make a lot of sense. If you have the cash sitting in your checking account, why not just save the $47,000? Congratulations, you're welcome. I saved you 47K, right? And that totally makes sense on the surface if that's all the farther you think, right? But if you think a little bit deeper and you say, true, but what could my money do for me if I just left it in my savings account, right? And what if I had a special savings account called my personal banking system, and it would grow at that same 6% for the 25 years without any tax on it, right? So I'm compounding the money that I otherwise would be paying tax on. So if that happens, and I go 25 years, just where the interest in year one also earns interest so that it gets a little bigger. Not impressive over there. But if you look at this, it's pretty impressive, right? The interest that was earned that year. And so the fact that we did not interrupt this compounding means that it turns into 215, or backing out the investment, earning $165,000, but paying 47 to do that, right? At the same interest rates. The reason is because I'm making principal and interest payments, and this 50 got smaller from day one. Where over here, it's compounding and growing. And this is actually how you would do it in real life, right? So you make an investment and you start getting cash flow from it, and you start refilling your checking account with it, right? Making payments to refill your checking account. On the other side, though, you could make those payments to the insurance company and then just let your money sit there and grow without putting anything in it. So this is why, going back to $100,000 to go into the car wash, just double these numbers. You'd pay $100,000 almost, 92,000 or something, 94,000 to in interest, which sounds ridiculous over 25 years, but you're going to make $236,000. And I'll gladly pay 97 for that, because I was able to allow the interest to earn interest over that time. And it's more private and it's more protected, and you can take a tax deduction for it. So there's a lot of other things, and there's $2 million of life insurance there. Sounds too good to be true.
Wow,
which
that's
is
amazing.
the biggest problem.
Yeah.
Yeah, but it's a long-term game. Like, the biggest detriment is that it's a long-term game.
You got to be in it for the long haul if you're going to.
Yeah, at least 5 years. For some people, that's not a long haul, but for some of us, it's a decent percentage of the rest of our life.
Right.
Talking about me.
So I know we start to have some. Yeah, I know we started to have some questions coming in, Jaden. I don't know if you've read through those.
Yeah, go ahead, Jaden.
Gary, I kind of want to.
I pulled up the first question here, but this question is asking more in terms of title. So I think this is more of a LLC type question, that sort of thing, which I can type out the answer here for.
Okay, sounds good. Yep. So that's a great question, though. I get that often, and I think maybe what might have caused that question is a lot of times people think about buying alternative investments, investing in alternative things from their solo 401k or their EQRP or something like that, right? And so that is another entity. So when your money is in a retirement account, it's a completely different being or a different entity that owns that real estate. You can say, I own it in my 401k, but it's actually not true. The government owns it in that 401k. And if you're nice and play by the rules that haven't changed on you, you get the money back out someday, right? Hopefully, and with a tax benefit. But that's another entity. And that's why they have all these rules in there that you can't go live in it, you can't work on it, and all those prohibited transactions. That's a completely different entity. When you use this life insurance as a bank, it's the same thing as having the money in your checking account and then making the investment from there, right? So it is not this other being that owns it and a totally separate set of rules. This is just simply a more efficient place to store the capital. And when you're ready to do the investment, you move it back into the checking account in the form of a loan and do it like normal, right? And when the money comes back, you can use it to pay down the loan. That's what I do, but you don't have to do that. That might be where the confusion came from there. Cool.
Gary, next steps in terms of if I'm a person, maybe I already have a life insurance policy or I don't,
Yeah.
what would you advise me to do to kind of move forward and further understand this type of product?
Yeah. So we have a couple more videos on our website at paradigmlife.net. And this is not exactly the right, let me see. I wanted to provide you all a link. So Jaden and I recently did another presentation, and this link, this QR code here will get you to that one. But really what I want you to do is to be able to get a free copy of Patrick Donahoe's book. It will tell us that you came in from a program called Money Is, but that's okay. We know that you're Multifamily Investor Network or PassiveInvesting.com. I mean, and so all the same, right? Basically, but this, you'll get an ebook copy and an audiobook copy of Patrick's book. And so you can do some information there. You can also set up an account at paradigmlife.net, and it's a new client portal that's got a ton of education and more coming every day. And so I'd recommend doing that. You know, after the initial education, initial concepts, and you figure out that it's kind of resonating with you, it will end up being a one-on-one conversation in a Zoom like this with me or Jaden. And it's us kind of looking at your specific situation. We send you this questionnaire that's actually available on the portal, and we take a snapshot of your financial situation and make recommendations based on your world, right? So we can talk generalities and we can talk about investments, but in the end, we have to be the glove maker that fits the perfectly fit glove for your family's hand, you know, your situation, because the policy that works for me doesn't work for Jaden and vice versa, right? I mean, for us and our families, because we're in a different phase of life right now. Yeah. So it's one or two or three or four, you know, individual meetings until we figure out whether this is a good fit. There is an application process in the background. Often for many people who are Jaden's age, it's just a questionnaire. Like sometimes you may have to do an exam, like a little, take a blood vial and, you know, height and weight and blood pressure stuff. And that's all free, and it happens in 20 minutes or so. And then maybe they even have to check doctor's records from your last hospital visit or something. But, you know, that's our job. We go through that process, doesn't cost anything. And then we come up with a rating. And once we know what their offer is, the insurance company's offer, we've dialed in the size of the policy to make it a perfect fit. And then you can make a decision, right? Here's the size we recommend. We've agreed that's the right size. Here's the offer they're making. Does this still make sense? You know? So that's the best way.
Got it. So here we are coming up on our hours mark. I don't see too many more questions in here. Is there any other items that you really want to leave with our audience, Gary, that you say, hey, if there's one thing I want to make sure that you know, either leaving this or thinking about the next steps on this, what is it?
Yeah, so I'd like to pass on some of the stuff I've learned the hard way in the last 50 years, and then I'll give Jaden the last word. So this hierarchy of wealth thing, I've dedicated my life to my podcast and helping other individuals find this path and safely get on the path. And this hierarchy of wealth really does a tremendous job of explaining the lens through which I look at when I make recommendations. And it's all about this control and risk, right? People get all caught up in interest rates and potential rates of return and tax benefits and all that stuff. And none of that matters if the whole thing falls over. And I've seen this fall over for so many people. Every time we go through an economic crisis or a family business has a unique crisis, the family has a crisis that happens with medical or something. So what you want to do when you're making decisions with your money is always make sure you have a large portion of it down in the foundation, wherever that is. It doesn't have to be a banking system with us. It could be a checking account. But you need to have a lot of control over your money and then start building up from there with alternative investments in either directly owned stuff or in syndication. The reason I like syndication is because many of us do have that passion, which is our business. And so like, I want to work with people one-on-one. I want to go out and present with Jaden. Like, I want to help people change their lives. And I can't be managing 50 rental properties and doing that. And so I kind of send my kids, my money off to summer camp. And I want to make sure that I do it in a place where it doesn't get lost or destroyed or stolen, right? And so it's important that you send it to the right place. And that's why I make relationships with Dan and Danny and others like them. And it's also helpful to reduce taxes and things. But the primary thing is you need to start off with a bulletproof foundation that all this stuff can last upon, and then have some advisors in your life, like a financial strategist, like a CPA, like an attorney, right, that can help you navigate when challenges are thrown your way. Most important thing, if you have two choices, they're relatively the same rate of return, choose the one that puts you in the driver's seat, the one that has you in the highest level of control.
That makes sense.
Dayton?
Yeah, and we just got a quick question in as well, so I'll answer that here. But the question was, what is the specific pathway to borrow against the policy for investing in assets? Does it leave the policy or is it used as collateral? And the answer to that is that it's used as collateral. So you could kind of think of it similarly to like a HELOC with a home, right? If you go do a HELOC, your home is the collateral. In this case, your life insurance policy is the collateral. So they're just giving you a line of credit. You can use that for anything, any purpose, anytime. You can pay it back how you'd like, that sort of thing. And then another side note here is I'm sending that link out that Gary was talking about. I just put that in the chat. That'll give you the book download, all the things that Gary mentioned. And then the only other thing I think I would add to this is that, these policies, what we do, it's not really intended to change your investments, right? Your investments are going to stay the same. You're going to keep investing in everything that you're doing currently. This is just meant to change the outcome. So it's meant to give you a little bit better outcome in the end versus what you would otherwise get.
Nicely said.
Well, Gary, Jaden, thank you so much for coming on. Really appreciate you guys being here. I learned a lot, and hopefully our audience members learned a lot. As you can see in the chat window, paradigmlife.net, if you want to learn more and have a personal conversation and learn more about this. Thank you, gentlemen, so much for your time today.
Thank you.
All right. Thank you.
Take care.